The Federal Reserve raises interest rates. Inflation comes in hotter than expected. Manufacturing activity contracts for the third month in a row. These aren't just headlines, they are signals. And if you know how to read them, they tell you something important about where the market is heading before most investors figure it out. Today I'm going to show you how to build a macro indicator tracker using AI. Welcome to the AI portfolio. Every week I show everyday investors how to use AI tools to research stocks smarter and faster. I'm not a financial advisor. Nothing here is financial advice. And you should always do your own research before making any investment decisions. Macro analysis used to be something only institutional investors did. AI changes that. Macro indicators are economic data points that tell you about the health and direction of the broader economy. They fall into three categories. Leading indicators move before the economy does. Things like the yield curve, building permits, and consumer confidence. They give you an early warning. Coincident indicators move with the economy. Things like GDP growth, industrial production, and retail sales. They confirm what's happening right now. Lagging indicators move after the economy. Things like unemployment and corporate earnings. They confirm a trend that's already in place. Most investors focus on lagging indicators because they're easiest to find. Smart investors track leading indicators because that's where the edge is. You don't need to track every economic data point. These 5 give you the clearest picture. First, the yield curve, specifically the spread between the 10-year and 2-year Treasury yields. An inverted yield curve has preceded every recession in the past 50 years. Second, the Consumer Price Index, the official measure of inflation. It tells you how the Fed is likely to move on interest rates. Third, the ISM Manufacturing Index, a monthly survey of purchasing managers. A reading above 50 means expansion, below 50 means contraction. Fourth, initial jobless claims, the weekly count of new unemployment filings. A sharp rise is one of the earliest recession signals. Fifth, the Conference Board Leading Economic Index, a composite of 10 leading indicators that gives you a single headline number. Here's prompt 1, the Macro Snapshot. I'm going to give you the current readings for 5 key macro indicators. For each one, tell me whether the current reading is expansionary, neutral, or contractionary, and explain what it signals about the direction of the economy. Here are the readings. Yield curve spread, X basis points. CPI year over year, X percent. ISM Manufacturing Index, X. Initial jobless claims, 4-week average, X. Conference Board LEI, month over month change, X percent. Based on these 5 indicators together, what is your overall read on the current economic environment? This gives you a fast, structured summary of where the economy stands. In plain English, prompt 2 takes that macro read and translates it into portfolio implications. Based on this macro environment, paste your prompt 1 summary. Which sectors of the stock market tend to outperform and which tend to underperform? Explain the historical relationship between this type of macro environment and sector performance. Which sectors would you expect to see strength in, and which would you expect to see weakness in? What are the key risks that could cause this analysis to be wrong? Different economic environments favor different sectors. Rising rates hurt growth stocks and favor financials. Slowing growth hurts cyclicals and favors defensives. This prompt makes those connections explicit. Prompt 3 is the most actionable, testing your specific holdings against the macro environment. I hold company in my portfolio. Given the current macro environment, paste your summary. Analyze how this company's business model is likely to be affected. Consider its revenue sensitivity to economic growth, its exposure to interest rate changes, its pricing power in an inflationary environment, and its historical performance during similar macro periods. Is this company well positioned for the current environment, or does it face meaningful headwinds? What would need to change in the macro environment to make this a more or less attractive holding? This is the step most investors skip. They analyze companies in isolation, ignoring the macro tailwind or headwind they're operating in. Here's the workflow. Every month, when major macro data drops, CPI ISM, jobs, run prompt 1. It takes 5 minutes and gives you a current snapshot. Every quarter, run prompt 2 to check whether your sector allocation still makes sense given where the economy is. Anytime you're considering a new position or reviewing an existing one, run prompt 3 to stress test it against the macro environment. The goal is not to predict the economy. Nobody can do that consistently. The goal is to know which direction the wind is blowing, so you're not surprised when it affects your portfolio. 3 mistakes to avoid. First, treating macro analysis as a market timing tool. Macro indicators are slow moving. They tell you about trends over months and quarters, not days. Don't use them to make short-term trades. Second, overweighting any single indicator. The yield curve is powerful, but it's given false signals. CPI alone doesn't tell you what the Fed will do. Use the full picture. Third, ignoring the lag between indicators and market performance. Even when the macro picture is clear, markets often move before the data confirms it, and sometimes they move in the opposite direction for longer than seems rational. Your homework this week: go to the Federal Reserve's website and pull the current 10-year and 2-year Treasury yield spread. Find the latest ISM manufacturing report. Look up the most recent initial jobless claims number, then run prompt 1. You'll have a macro snapshot in about 2 minutes. Then take one stock you own and run it through prompt 3. See if the macro environment supports your thesis or challenges it. That's it for episode 22. Subscribe for a new video every week on AI and investing in plain English. See you next time.